So usually when you're trying to figure out a medical diagnosis, you kind of expect a certain level of precision, right?
Yeah, absolutely. You want a clear answer.
Right. Like you think of it almost like mechanical engineering. You fall, you break your arm, the x-ray shows that stark, jagged white line across the bone, and the doctor just points at it and says, there it is.
Right. It's entirely binary. The bone is either broken or it's intact. We just naturally gravitate toward that kind of clean, undeniable visual proof.
Exactly. We find it comforting.
Right.
We like our complex problems to be visible and easily categorized. But then you step into fields like neurodevelopment or like complex autoimmune diseases, and suddenly that clean x-ray machine is just totally useless.
Yeah, you're looking at a diagnostic landscape that is incredibly murky. You have to evaluate a dozen different overlapping systems just to even make an educated guess.
And if we take that exact same diagnostic metaphor and apply it to the stock market, specifically, to the anatomy of a corporate turnaround, you find the exact same frustration.
Oh, 100%. Investors want that clean x-ray.
They really do. They want a binary buy or sell signal. But when you are evaluating a manufacturing company that's trying to drag itself out of a multi-year industry-wide depression, the picture is almost never a clean break.
No, it's not. You are forced to navigate these diagnostic muddy waters. I mean, you can't just look at a single top-line revenue number.
Right.
You really have to examine the shadows on the balance sheet, the surrounding tissue of their operating expenses, the structural integrity of their supply chains.
And the long-term viability of their R&D, too.
Exactly.
And that is exactly what we are diagnosing for you today. We're looking at 3D Systems Corporation, trading under the ticker symbol DDD, and specifically analyzing their first quarter 2026 earnings conference call, which took place on May 12, 2026.
Right. And the sources we are working from are the raw, unedited earnings transcripts. So that features CEO Dr. Jeffrey Graves and CFO Phyllis Nordstrom, alongside some foundational corporate profiling that explains what this company actually builds.
Yeah. And the mission for this deep dive is pretty unique. We were taking that fast-paced, highly actionable style of Wall Street earnings analysis.
The kind of rapid-fire data breakdown you might catch in like a 5-minute financial TV segment.
Exactly. But we're slowing the tape down. We want to give you the headline numbers, the story behind them, the management guidance, and then the bottom line.
Because, frankly, reading flashing red and green numbers on a ticker tape doesn't tell you how a business actually operates.
It really doesn't.
To understand if a turnaround is genuine, we have to look at the mechanics of the factory floor, the regulatory hurdles they are clearing, and the actual utility of the technology they are selling to, like hospitals and aerospace contractors.
But before we pull apart their first quarter revenue numbers, we really need to establish exactly where 3D Systems has been living for the past few years.
Yeah, it hasn't been pretty.
No. The term CEO Jeff Graves used on the call was a multi-year trough.
Mm-hmm.
But what does that actually mean for you as an investor in the context of the additive manufacturing sector?
Well, a trough in this specific macroeconomic context is essentially a frozen landscape for capital expenditures.
Right.
For the past several years, the global economy has just been subjected to this highly volatile cocktail of massive geopolitical challenges, unpredictable supply chain disruptions, and crucially, soaring interest rates.
Let's focus on those interest rates for a second, because I think a lot of retail investors really underestimate how directly the Federal Reserve impacts a company that sells 3D printers.
Oh, it is a direct, undeniable tether. I mean, 3D Systems does not sell cheap consumer electronics.
No.
They sell multi-million-dollar suites of highly advanced industrial and medical additive manufacturing systems. So if you're the manager of an aerospace parts factory or the director of a large dental lab, purchasing a new fleet of direct metal printers is a massive capital expenditure.
You are very likely financing that purchase.
Precisely. You are taking out a loan to buy the machines that make your product. And when interest rates are hovering near zero, money is cheap. You aggressively upgrade your factory because the cost of borrowing is negligible compared to the efficiency gains.
Right. But when central banks aggressively hike interest rates to fight inflation, the cost of financing that multi-million-dollar equipment fleet just skyrockets.
The math suddenly just doesn't work. The monthly payment on that factory upgrade doubles or even triples.
So the factory manager hits the brakes.
Exactly. They look at their aging equipment and say, well, we'll just make do with what we have for another year. They delay the purchase.
And when every factory manager and medical device manufacturer in the world makes that exact same decision simultaneously, the entire additive manufacturing industry enters a deep, suffocating trough.
Yeah, revenue dries up across the board. Not because the technology isn't desirable, but because the macro environment makes it too expensive to acquire.
So that is the winter they have been surviving, which makes the data from this Q1 2026 call so surprising.
It really was a shock.
Wall Street was expecting the freeze to continue. Instead, 3D Systems reported a first quarter consolidated revenue of $95.5 million. That is an 11% year-over-year increase.
And in the context of the macroeconomic environment we just outlined, posting double-digit revenue growth is a profound signal.
It really is.
It implies that the freeze is finally thawing. Customers who delayed their purchases for 2 or 3 years simply can't wait any longer. Their old machines are either failing or their competitors have upgraded and are operating more efficiently, forcing their hand.
But I want to look closely at where that 11% growth is actually coming from, because this is where the traditional narrative around 3D printing completely fractures. When you say 3D printing, most people immediately picture industrial applications, right? You picture automotive prototypes, engineering widgets, maybe architectural models.
Yeah, that has historically been the bread and butter of the industry, the rapid prototyping phase of industrial design.
But the Q1 data reveals a massive structural shift. So 3D Systems operates in 2 primary segments, industrial solutions and healthcare solutions.
Let's look at industrial first.
Yeah. In Q1, the industrial segment grew a very anemic 1.6% year over year, landing at $45.4 million.
Which is basically barely keeping pace with inflation. That 1.6% tells you that the broader traditional manufacturing sector, the car companies, the consumer goods factories, they're still acting incredibly cautious.
They are not fully opening their checkbooks yet.
Not at all.
But then you look at the other side of the ledger. Healthcare solutions grew an astonishing 21% year over year, hitting $50.1 million for the quarter.
Wow.
And you don't have to be a math genius to see what just happened there. $50.1 million in healthcare versus $45.4 million in industrial. For the first time ever, printing things for the human body is officially a larger business for 3D Systems than printing things for factories.
It fundamentally forces you, as an investor, to reevaluate what kind of company you're actually analyzing. If you value 3D Systems as a purely industrial manufacturer, your models are going to be wrong.
Completely wrong.
Healthcare revenue is a completely different animal than industrial revenue, primarily because of the barrier to entry and the extreme stickiness of the ecosystem.
Okay, so what makes it so sticky? Like if a hospital buys a 3D printer for surgical guides, what stops them from just buying a cheaper competitor's printer 2 years later?
The regulatory and workflow modes are just absolute iron. Let's say a medical device manufacturer integrates a 3D Systems printer and their proprietary biocompatible titanium powder to manufacture spinal implants.
Okay.
They don't just plug the machine in and start selling implants. They have to run that specific machine with that specific material through grueling multi-year FDA or EU regulatory trials to prove that the resulting implant is safe, sterile, and structurally sound for human implantation.
Wait, so the approval isn't just for the final implant. It's an approval of the entire manufacturing process.
Exactly. The FDA validates the specific printer, the specific laser parameters, and the specific metal powder as a unified system. Once you spend tens of millions of dollars and several years securing that regulatory approval, you are locked in.
Because you can't simply swap out the 3D Systems printer for a cheaper machine from a rival startup.
Right, because you would invalidate your FDA clearance. You'd have to start the entire trial process over from scratch.
The switching costs are astronomically high. It's almost operational suicide to change vendors once you're embedded.
And that is why seeing healthcare grow 21% and become the dominant revenue segment is such a bullish indicator for their long-term stability. It represents highly defensible recurring revenue.
Right, because medical customers continually buy the proprietary metal powders and polymer resins required to feed those approved machines, which generates a massive recurring high-margin consumables business.
Exactly. Which brings us perfectly to the margins.
Yes, let's talk margins. We've established that the top line is growing, driven by that sticky healthcare segment. But what is happening underneath that revenue? Looking at the profitability metrics, and CFO Phyllis Nordstrom reported a non-GAAP gross margin of 36.1% for the first quarter.
Now, 36.1% on its own might just look like a number, but she noted that this is a 600 basis point expansion from the prior year.
So let's translate that for clarity. A basis point is simply 1/100th of a percentage point. So a 600 basis point expansion means their gross margin increased by 6 full percentage points year over year.
And in a hardware-heavy manufacturing business, finding an extra 6% of gross margin in a single year is, frankly, exceptional.
It really is. It usually requires a massive overhaul of the supply chain or a radical change in pricing power.
But there is a massive caveat here, and this is where investors need to be incredibly careful when reading earnings press releases. Nordstrom explicitly stated that this margin expansion is calculated by adjusting for the 2025 divestitures.
Yeah, we have to scrutinize this because it sounds like accounting magic. In 2025, 3D Systems sold off a chunk of their legacy software businesses, specifically entities like Geomagic, 3D Expert, and Oknon.
And software businesses inherently operate with massive growth margins. I mean, once you pay your developers to write the code, distributing 1 million copies of that software costs virtually nothing. The gross margins can easily float in the 80% to 90% range.
Wow. Okay.
Hardware, on the other hand, requires buying steel, lasers, physical microchips, and paying for massive factory floor space. Hardware margins are generally much lower, often in the 30% to 40% range.
Right. So if 3D Systems was an umbrella company holding both high-margin software businesses and lower-margin hardware businesses, selling off the software side should mathematically crush their overall corporate margin.
That is exactly what happens on a pure, unadjusted GAAP accounting basis. If you remove your most profitable divisions, the blended average just drops.
So when Nordstrom claims a 600 basis point margin expansion, she's asking us to ignore the fact that they sold the golden goose.
Yeah, she is saying, let's look at apples to apples.
Right. If you pretend the software businesses never existed last year, and you just look at how the physical printers and materials businesses performed in Q1 of last year versus Q1 of this year, the margin on that specific core hardware business jumped 6%.
And you are right to be skeptical of adjusted numbers, but in this case, the CFO is actually providing the correct lens for evaluating the ongoing company. The software divisions are gone. They are irrelevant to the future cash flows of 3D Systems.
What matters to an investor today is whether the factory floor that remains is operating efficiently.
Exactly. And an apples-to-apples 600 basis point improvement tells you that the core manufacturing process, the supply chain management, and the pricing power of their printers and materials have radically improved.
They're squeezing significantly more profit out of every physical machine and vat of resin they sell, which bleeds directly into the most critical metric of a turnaround, EBITDA. The adjusted EBITDA for Q1 was a positive $2.1 million.
Let's break down why that specific acronym matters so much here. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
It's essentially a proxy for the actual pure operating cash flow of the business before the accountants get involved with complex tax write-offs and paper depreciation of factory assets.
Exactly. It tells you whether the core engine of the business is pumping out cash or burning it. Last year, adjusted for the divestitures, the remaining hardware business was deeply in the red. Generating a positive $2.1 million in adjusted EBITDA this quarter represents a staggering $28.2 million improvement year over year.
That's huge.
They swung a heavy industrial manufacturing engine from burning cash to generating cash.
But I'm going to push back hard here. I am looking at the final bottom line earnings per share. The final non-GAAP loss per share was $0.01. Yes, losing a single penny per share is significantly better than the $1.21 loss from the prior year, but a loss is still a loss. Why is the market and why is CEO Jeff Graves taking a victory lap over a quarter that ultimately lost money on per share basis? Are they just shrinking their way to profitability by cutting costs so hard that they're starving the future of the company?
That is the most vital question an investor can ask when faced with a company boasting about EBITDA while posting a net loss. You have to interrogate the operating expenses to see how they achieve that cash flow.
Right.
Over the last 6 quarters, 3D Systems executed a brutal, highly disciplined efficiency program. They achieved $55 million in annualized cost savings.
$55 million is a massive amount of overhead to strip out of a company this size. How do you cut that deep without amputating a vital organ?
Well, you do it through facility consolidation, supply chain optimization, and stripping out middle management bloat that accumulates over years of acquisitions. When a company acquires smaller startups, which 3D Systems has done historically, they often end up with redundant HR departments, redundant marketing teams, and just fragmented manufacturing sites.
Yeah, that makes sense.
The last 6 quarters were spent aggressively integrating and streamlining those operations.
But the danger of cutting $55 million is that you accidentally cut into the muscle. You lay off the R&D engineers, or you slash the marketing budget so deeply that your sales collapse.
And that is why the $1.01 loss is actually a victory, because we already established that revenue grew by 11%. If you slash your operating expenses by 35% year over year, which they did, bringing non-GAAP operating expenses down to $36.6 million, and your revenue continues to accelerate by double digits, you've achieved the holy grail of corporate turnarounds.
Wow.
You've successfully stripped out the administrative fat without harming the commercial muscle.
So the sales team is actually selling more machines despite having fewer resources.
Exactly. The 1 cent loss on the bottom line is heavily influenced by the depreciation and amortization part of EBITDA. Because they're a hardware company, they have massive historical investments in factories and equipment that they are required to depreciate on paper over time. That paper depreciation drags down the earnings per share, but it doesn't represent cash leaving the bank account today. The positive EBITDA proves that operationally, the business is now self-sustaining.
And they are sitting on $86.5 million in cash, and they aren't bleeding it out on the factory floor anymore. They don't need to go begging to the debt markets or dilute current shareholders with secondary stock offerings just to keep the lights on.
Right.
Okay, so the financial architecture is stabilizing, the engine is running lean and generating cash, but spreadsheets and financial engineering don't exist in a vacuum. A 600 basis point margin expansion and a 21% surge in healthcare revenue only happens if the physical products you are building are fundamentally superior to what the market previously had.
Exactly.
So I want to leave the financial abstractions behind and examine the actual biology and mechanics of what they're printing. Let's dig deeply into the dental market, because CEO Jeff Graves made a massive claim on this call. He stated that the next Dent 300 jetted denture solution is the most successful new product launch in 5 years.
And when a CEO of a publicly traded company uses language like that on an earnings call, they are not engaging in casual hyperbole. They are signaling to institutional investors that a specific targeted R&D investment has evolved into a commercial blockbuster.
So let's dissect this. Dentures. It sounds almost mundane. We aren't talking about printing a futuristic bionic eye. We are talking about false teeth. Why is this such a massive commercial catalyst?
Well, to understand the breakthrough, we have to understand the nightmare that is traditional denture manufacturing.
Yeah, lay it out for us.
The analog workflow for creating dentures is one of the most labor-intensive, imprecise, and frustrating processes in modern dentistry. It begins with the patient biting into a tray full of messy, uncomfortable alginate putty to create a physical impression of their gums.
Oh, I hate that stuff.
Yeah, it's terrible. That physical mold is then mailed to an off-site dental laboratory,
where a highly skilled, highly paid technician has to pour plaster into the mold to create a model of the patient's mouth. Then they have to manually set acrylic teeth into a wax base, boil out the wax, inject permanent acrylic, cure it, and then spend hours manually grinding, polishing, and adjusting the final piece.
It requires immense manual dexterity. It takes weeks to complete. And because the acrylic shrinks during the curing process, the final fit is notoriously poor.
Right.
The patient has to return to the dentist multiple times for painful adjustments as the rigid acrylic grinds against their sensitive gum tissue.
So it is a high-friction, low-margin nightmare for everyone involved.
Yeah.
Compare that analog reality to what 3D Systems is deploying with the next Dent 300. We're moving from the dark ages into precision digital manufacturing.
Yeah, the Nexent 300 is a jetted solution, and this is a critical technological distinction. Older 3D printers often use SLA technology, where a laser cures a vat of liquid resin. Jetting technology operates much more like an incredibly advanced inkjet printer. It features a print head that glides back and forth, depositing microscopic droplets of highly specialized, biocompatible, photocurable resin. An ultraviolet light trailing immediately behind the print head instantly cures those droplets into solid plastic.
And the precision of jetting is microscopic. But the real breakthrough isn't just the printer, it's what they are printing. Graves specifically highlighted monolithic dentures.
Right, so in traditional manufacturing, the pink gums and the white teeth are created separately and then chemically bonded together.
And that bonding line is a structural weakness. It is where bacteria collects,
right,
and it is the exact point where a denture will snap if dropped in the sink.
A monolithic denture, though, is printed as a single, unified, continuous piece of advanced polymer. The gums and the teeth are physically one structure. Using different resins jetted simultaneously, they can create the aesthetic transition from the translucent pink of the gum to the rigid white of the tooth without any mechanical joint. The resulting denture is exponentially stronger, highly wear-resistant, and visually indistinguishable from natural teeth.
Yeah, we don't have to guess if the market actually wants this, because Graves provided explicit, real-world validation on the call. He highlighted a specific customer, Rowe Dental Lab, run by CEO BJ Kowalski.
Yes, Rowe Dental is a massive player in the U.S. market, and they became the first major laboratory to deploy an extensive multi-machine fleet of these next-gen 300 systems.
And the operational metrics that Rowe Dental reported are just staggering. By deploying this digital workflow, taking digital intraoral scans directly from the dentist and feeding them into the next-gen fleet, they tripled their output of monolithic dentures.
Tripling production without tripling the physical footprint of the lab or hiring 3 times as many skilled artisans. The unit economics for the lab fundamentally detach from labor constraints.
And the turnaround time drops from weeks to days. The fit is mathematically perfect because there's no acrylic shrinkage. If the patient eventually loses or breaks the denture, the lab doesn't need to start over. They simply pull up the digital file and press print again.
It's a total paradigm shift for dental economics.
But how large is this market really? Is this a niche upgrade for a small subset of patients, or is this a structural shift for a massive population?
Well, Graves provided the total addressable market, or TAM, and the scale is really difficult to comprehend. With recent regulatory victories, specifically gaining US FDA approval in late 2025, and securing an unexpected European Union phase IIA approval 2 months ahead of schedule in Q1, they've officially unlocked an addressable market of 60 million edentulous patients.
Wait, edentulous? That's the clinical term for individuals who have lost all of their teeth, right?
Yes. 60 million people globally who require full arch restorations. Graves noted that this technology addresses roughly 1/3 of the entire global denture market. We are talking about a multi-billion-dollar runway, as laboratories worldwide realize they must adopt digital workflows to remain price competitive.
And that's just full replacements. There is a secondary narrative in the dental segment that I find equally fascinating, which focuses on materials and regulatory bottlenecks. I call it the Vertex trademark win.
Yeah, Vertex is 3D Systems' brand for highly specialized prosthetic repair materials. These are the advanced resins used to fix existing dental appliances.
And this material has been an absolute powerhouse in Europe for years. Dentists love it, the clinical outcomes are fantastic, but they couldn't sell a single drop of it in the United States. And it wasn't because the FDA deemed the material unsafe or ineffective.
No, it was pure bureaucratic friction. They were locked in a protracted, multi-year legal dispute over the Vertex trademark name in the U.S. Lawyers arguing over intellectual property rights completely halted the commercialization of a life-improving medical product.
But late last year, they finally resolved the trademark dispute. The artificial barrier evaporated, and the impact on Q1 revenue was immediate and violent.
Right. By simply gaining the legal right to sell an already proven material in a new geography, they effectively doubled their addressable market for Vertex overnight.
Graves noted a massive surge in new dentists purchasing these specific products in Q1. It perfectly illustrates how regulatory and legal clearances are just as critical to a healthcare turnaround as the actual engineering. You can invent the greatest resin in the world, but if the lawyers say no, the spreadsheet stays flat.
Exactly. So the dental revolution is clearly driving the volume, but if we move deeper into the hospital, we find the technology that is driving the sheer awe. Let's transition from the next-dent polymers to the heavy metal operations in medtech and orthopedics.
This is where engineering directly intersects with human biology in ways that sound like science fiction. We're talking about their flagship metal platform, the DMP 350.
Direct metal printing. These are not the desktop machines printing plastic trinkets. These are massive, heavy industrial systems that operate in completely sealed, inert, argon environments.
Right. And Graves noted strong, accelerating sales of the DMP 350 to major medical device customers. And this connects directly back to that trough we discussed earlier. Medical device manufacturers, the companies that supply hospitals with joint replacements and surgical tools, froze their capital spending for years. They kept their aging 3D printers running on fumes.
But eventually, mechanical fatigue sets in. Or, more importantly, the quality of the new generation of printers becomes so vastly superior that a device manufacturer is forced to upgrade just to meet the new clinical standards demanded by surgeons.
That hardware refresh cycle is finally initiating, and the DMP 350 is capturing that pent-up demand.
And what are they manufacturing with these lasers? The primary applications are titanium spinal implants and cobalt chrome joint replacements like knees and hips.
The mechanics of a titanium spinal implant are fascinating. When a surgeon fuses a spine, they insert a metal cage between the vertebrae. Historically, these were machined out of solid blocks of metal. But a solid block of metal is smooth. Human bone does not like to adhere to a smooth, flat surface.
It encapsulates it or rejects it completely.
Exactly. But with the DMP 350, engineers can 3D print a titanium implant with a highly engineered, mathematically precise, porous lattice structure on the outside. It looks almost like a metallic sponge.
And the biological response to that structure is incredible. The patient's living bone cells actually recognize that porous lattice as a scaffold. The bone grows into the titanium, fundamentally fusing the living tissue with the metallic implant.
Wow.
It's a process called osseointegration, and it drastically reduces the failure rate of spinal fusions. You literally cannot manufacture that porous lattice using traditional milling machines. It can only be achieved through advanced 3D printing.
But as incredible as the orthopedic applications are, the segment of the call that genuinely made me stop and rewind the transcript was the discussion surrounding oncology.
Oh, the surgical planning and bespoke trauma implants. This is personalized medicine operating at its absolute apex.
Graves laid out the workflow for treating severe bone cancer. Imagine a patient has an aggressive tumor in their femur. The traditional surgical approach is incredibly brutal. The surgeon opens the leg, visually assesses the tumor, and cuts out a massive section of the bone to ensure they get all the margins. Now the patient is missing a massive chunk of their leg bone.
And the reconstructive phase of that traditional surgery is a nightmare of improvisation. The surgeon might try to harvest a bone graft from the patient's pelvis, creating a second painful surgical site. Or they might take a bone from a cadaver, which carries a risk of rejection. Or they take a generic off-the-shelf metallic rod and physically grind it, file it, and bend it right there in the operating room, trying to make it fit into the jagged void they just cut out.
Which extends the surgery by hours. The patient is under anesthesia longer, the risk of massive infection skyrockets, and the mechanical fit is almost never perfect, leading to lifelong mobility issues. Now listen to the digital workflow 3D Systems is providing.
It begins weeks before the surgery. The patient undergoes high-resolution CT and MRI scans. Those digital scans are sent to 3D Systems biomedical engineers. Using proprietary software, the engineers sit down virtually with the surgical team. They build a complete 3D digital model of the patient's exact bone and the exact tumor.
Together on a computer screen, they plan the exact cut lines for the surgery. They decide precisely where the saw will enter and exit.
Then 3D Systems prints two critical items. First, they print physical, sterilizable cutting guides. The surgeon snaps these plastic guides directly onto the patient's bone in the operating room, and the guide ensures the saw blade follows the exact mathematical path planned on the computer.
But the magic is the second item. Because they know exactly what shape of bone they are removing, they 3D print a bespoke, perfectly matched replacement implant. Graves specifically mentioned they are utilizing PEEK.
Polyether ether ketone. It is an incredibly advanced, high-performance engineering polymer. It is highly biocompatible, meaning the body doesn't reject it, and crucially, its mechanical properties, how much it flexes and bears weight, are incredibly similar to human cortical bone.
So the surgeon makes the perfect cuts using the printed guides, removes the tumor, and then takes this customized 3D printed PEEK implant and drops it into the void. It fits flawlessly like a jigsaw puzzle piece.
The time saved in the operating room is massive. The recovery outcomes for the patient are exponentially better. And Graves noted that their manufacturing processes have become so fast and localized that they aren't just doing this for scheduled oncology surgeries anymore. They're scaling this workflow to handle emergent trauma.
Meaning, a patient comes into the emergency room after a horrific motorcycle accident with a shattered pelvis. And within a matter of a few days, 3D Systems can analyze the scans, design a custom reconstructive implant, print it, sterilize it, and deliver it to the surgical team.
It is a breathtaking capability.
And it is entirely insulated from macroeconomic cycles. You do not delay a tumor removal because interest rates are at 5%.
Exactly, which perfectly illustrates why healthcare segment revenue is so robust. However, as objective analysts, we must point out that no quarter is completely unblemished. There was a specific headwind in the healthcare data that requires scrutiny.
Yes, Graves explicitly acknowledged that the massive medtech growth was actually suppressed slightly. It was partially offset by unexpectedly lower sales to one specific, highly strategic customer. And he went out of his way to clarify the nature of that shortfall. It was not a macroeconomic demand issue. It was not a competitor stealing the contract.
No, he described it as a localized internal business disruption at that specific customer's facility.
If I'm translating the corporate speak correctly, it sounds like an operational bottleneck. My analogy for this scenario: imagine you have a state-of-the-art, perfectly optimized automotive assembly line capable of churning out 1,000 cars a day. The consumer demand for the cars is off the charts. The robotic welders are humming.
Right.
But suddenly, the entire line grinds to a halt because the one single truck delivering the spark plugs blew a tire on the interstate.
The technology isn't broken, the demand hasn't vanished, but a localized, highly specific logistical failure prevents the final product from being completed, which means the revenue cannot be recognized that quarter.
But the critical piece of information Graves provided to Wall Street analysts was about the resolution. He stated that this specific customer disruption was entirely resolved by the end of Q1.
And that detail fundamentally shifts the narrative from a negative to a positive. If the disruption is resolved, but the medical demand for the product remains, that unrealized revenue doesn't simply disappear, it becomes deferred revenue.
Pent-up demand. That medical device company still needs those DMP 350 printers and that titanium powder.
Yeah.
They just couldn't take delivery in March.
Exactly. So that deferred order essentially rolls over, creating a very strong, highly probable revenue catalyst waiting to be realized in the Q2 or Q3 ledger. It creates a coiled spring effect for that specific account.
All right, so we have thoroughly mapped the anatomy of the healthcare turnaround. We've gone from the dental lab to the oncology ward. I want to shift our focus entirely now. I want to move away from the biology of the human body and look toward the extreme engineering of the sky. We need to dissect the industrial segment, specifically the aerospace and defense pivot, because the data here requires serious interpretation.
It does. It requires peeling back the layers because at first glance, the top-line industrial number is downright ugly. We established earlier that the overall industrial segment only grew 1.6%.
Yeah.
If you were a retail investor scanning the headlines, you look at 1.6% and you assume the industrial side of 3D Systems is dead weight, dragging down the soaring healthcare division.
But when you actually crack open that segment and look at the subdivisions, you find a massive exploding engine hidden inside. The broader industrial sector printing injection molds for consumer plastics, prototyping automotive parts, that sector is indeed sluggish, suffering from the macro trough. But the aerospace and defense subsegment, the A&D division, it grew over 20% year over year.
20% growth in hardware sales to defense contractors and space exploration companies is staggering. It means that A&D is single-handedly carrying the entire multinational industrial segment into positive territory.
And to understand why aerospace engineers are suddenly ravenous for 3D Systems technology, we have to endure a bit of a physics lesson. 3D Systems dominates this niche because they offer two vastly different, yet highly complementary approaches to manufacturing mission-critical metal components.
When an analyst asks about their metal portfolio, they're usually referring to direct metal printing, or DMP. We touched on this with the spinal implants, but the aerospace application is far more punishing.
Break down the actual mechanics of DMP in an industrial setting, because the term 3D printing metal still conjures up ideas of a hot glue gun melting steel wire, which is entirely inaccurate.
It is entirely inaccurate. A DMP machine is essentially a highly controlled, localized forge. The process occurs inside a hermetically sealed build chamber that is flooded with an inert gas, usually argon, to completely remove any oxygen. Oxygen is the enemy of pure metallurgy at high temperatures.
Right. So inside the zero oxygen chamber, a recoater blade spreads.
This fusion process is called sintering. Once that layer is sintered, the build plate drops by a fraction of a millimeter, a fresh layer of powder is swept across, and the laser fires again. Layer by microscopic layer, a fully dense, incredibly complex metal part rises out of the powder bed.
And Graves made a very specific, highly technical point during the call that we need to highlight. He stated that the 3D Systems DMP process uses absolutely zero binders, no chemical glues. Why is the absence of a binder so critical to the defense industry?
Because in extreme engineering, binders are a fatal flaw. Some competing 3D printing technologies spray a chemical binder, essentially a microscopic glue into the metal powder, to hold the shape together during the print. After the part is printed, they put it in a furnace to burn away the glue and fuse the remaining metal.
But when you burn away a chemical glue that was occupying physical space inside a solid object, what happens?
It leaves a void, a microscopic bubble of empty space inside the metal. If you are printing a decorative metal paperweight, a microscopic void doesn't matter. But if you are printing a complex turbine blade for a jet engine,
a blade that is spinning at 30,000 revolutions per minute, subjected to 2,500 degrees Fahrenheit of sustained exhaust heat.
Exactly. Under those extreme rotational and thermal stresses, that microscopic void becomes a stress fracture. The fracture propagates, the turbine blade shatters, and the jet engine violently explodes in midair.
Wow.
The aerospace industry has zero tolerance for porosity. Graves made it explicitly clear, without a pure, binder-free DMP process that guarantees 100% density, you simply cannot participate in the highest value, mission-critical portion of the aerospace market.
My simplified analogy for this.
Yeah.
DMP is like building an intricate sandcastle, but instead of using water and buckets, you are using perfectly dry sand and a localized lightning bolt to instantly fuse the sand into solid, flawless glass.
Yeah.
There's no paste, no glue, just the pure, violent transformation of the raw element.
It is a perfect analogy for the thermal dynamics involved, but DMP is only half of their aerospace arsenal. Graves also discussed a completely different process that relies on their polymer expertise: SLA printed patterns for investment casting.
Stereolithography, using lasers to cure liquid resin. But how does printing a plastic model help an aerospace engineer build a rocket engine out of superalloys?
It bridges the gap between digital freedom and ancient metallurgy. Investment casting is a manufacturing process that is thousands of years old. Traditionally, you carve a perfect replica of the part you want out of wax. You dip that wax model repeatedly into a ceramic slurry until a thick, hard ceramic shell forms around it.
Then you throw the whole thing into an oven, the ceramic hardens into a mold, and the wax inside melts and flows out, hence the term lost wax casting.
You are left with a hollow ceramic shell. You pour molten metal into the shell, let it cool, shatter the ceramic, and you have your metal part. It is a brilliant, proven process, but the bottleneck has always been creating that initial wax pattern.
Right.
If you want to cast a highly complex, geometrically intricate rocket propulsion manifold, carving the wax pattern by hand or machining it takes months and costs a fortune.
Enter the SLA printer.
Exactly. 3D Systems uses massive SLA printers to manufacture the pattern out of a specialized, cleanly burning plastic resin. They can print geometries that are physically impossible to carve or machine internal cooling channels that curve like human veins, complex honeycomb structures.
So they take this incredibly complex, mathematically perfect 3D printed plastic pattern and they hand it over to a traditional foundry. The foundry coats it in ceramic, burns out the 3D printed plastic, and pours in the molten metal.
It gives aerospace engineers the limitless geometric complexity and rapid iteration of 3D printing, combined with the deeply understood, deeply trusted material science of traditional casting. Graves noted that the most advanced aerospace systems in development today, hypersonic flight vehicles, next-generation rocket engines, are actively utilizing both the direct metal printing and the SLA casting processes, depending on the specific thermal and structural requirements of the individual component.
And the real-world examples he provided on the call were genuinely staggering. Let's talk about the satellite components. He specifically highlighted titanium antenna brackets.
By utilizing topological optimization software, where a computer analyzes the stress loads on a bracket and removes any material that isn't structurally necessary, they designed a bracket that looks almost organic. It looks like the hollowed-out bone of a bird.
And then they print it via DMP in pure titanium. Graves stated these printed brackets are 25% lighter than traditionally manufactured brackets, and the production time is cut in half.
In the economics of space exploration, weight is everything. Every single ounce of mass that you launch into low Earth orbit requires an exponential amount of expensive rocket fuel. If a satellite manufacturer can shave 25% of the weight off every structural bracket on the chassis without sacrificing strength, they save millions of dollars in launch costs over the life cycle of a satellite constellation. It is an immediate, massive return on investment.
He also detailed the mass production of turbine blades for industrial power generation and jet engines. And the materials they are processing aren't standard steels. We are talking about titanium, zirconium, and highly advanced nickel-based alloys.
Nickel superalloys are notoriously difficult to machine traditionally because they're so hard, but they are essential for aerospace propulsion because they maintain their structural integrity at temperatures that would turn steel into liquid.
And he specifically mentioned copper-nickel alloys for the U.S. Navy. This is a critical point for you as an investor to absorb. This is no longer rapid prototyping. They are not printing plastic mock-ups so engineers can see what a part looks like. They are engaging in end-use, mission-critical mass manufacturing. And the demand for these classified high-performance parts is so intense that 3D Systems is physically running out of floor space to print them.
Which necessitates the massive capital project they are currently executing, the Littleton expansion.
Yes. Graves detailed an aggressive physical footprint expansion in Littleton, Colorado. They are currently building out a brand new 80,000 square foot manufacturing facility, and this facility is entirely dedicated to industrial metal part production.
It is a highly strategic deployment of capital. They already operate a facility in Littleton that historically focused heavily on the rigorous quality control required for healthcare implants. By building the new aerospace facility right next door, they are leveraging that existing culture of zero-defect manufacturing.
You take the exact same quality assurance protocols required to ensure a spinal implant doesn't fail inside a human body, and you apply them to a turbine blade to ensure it doesn't fail inside a jet engine.
The regulatory overlap is profound. Graves expects the grand opening of the Littleton facility to occur in late summer. When that 80,000 square foot factory comes online, packed with DMP machines running 24/7, it provides a massive physical manifestation of that 20% A&D growth narrative. It represents a massive expansion of their manufacturing capacity right as the defense spending cycle accelerates.
The aerospace narrative is incredibly bullish. But as we analyze this turnaround, we have to acknowledge the gravity of the real world. A company that builds physical machines and relies on global supply chains is inherently vulnerable to the chaos of geopolitics. And Jeff Graves was surprisingly candid about the geopolitical headwinds severely impacting specific sectors of their business.
He had to be candid because the macro environment is directly suppressing their ability to realize revenue despite having the technology and the demand.
The acute conflict in the Middle East was cited as a major specific drag on performance, and it impacted them in two distinct ways. First, localized demand. Graves called out their jewelry business specifically.
3D Systems manufactures the MJP300W Plus Phyllis, a highly advanced wax printer used globally by master jewelers to cast complex high-end rings and necklaces. The Middle East, particularly regions like Dubai, serves as a massive central hub for global jewelry manufacturing and trading.
When a region is gripped by severe geopolitical instability and the threat of escalating conflict, luxury commerce freezes. Master jewelers in the Middle East are not buying $50,000 wax printers when airspace is being closed and shipping lanes are threatened. The local demand simply evaporated.
But the secondary impact of the Middle East conflict is far more insidious, and it affects their entire global portfolio. Graves detailed a massive global logistics nightmare.
When conflicts escalate near critical maritime choke points like the Red Sea, global shipping companies refuse to transit the area. Cargo ships are forced to reroute thousands of miles around the continent of Africa,
which extends shipping times by weeks and causes the cost of a shipping container to quadruple. Graves explicitly noted that simply getting their heavy industrial printers, raw metal powders, and polymer resins delivered to customers across Europe and Asia became incredibly difficult in Q1.
You can manufacture the most advanced titanium printer on the planet, and a hospital in Germany can wire you the funds to buy it. But if that printer is sitting on a loading dock in South Carolina because there is no available space on a cargo ship, you cannot legally recognize that revenue on your quarterly earnings report.
The revenue is trapped in transit. As financial analysts, we have to contextualize this. This is not a failure of 3D Systems sales team, nor is it a failure of their technology. It is an exogenous macroeconomic shock. However, management must navigate the world as it currently exists, not as they wish it to be.
Which provides the absolute perfect, albeit painful, transition into the final analytical phase of our deep dive, management guidance. Or, as the tone of the call suggested, the Q2 caution.
This was undeniably the most tense and counterintuitive segment of the entire earnings call, particularly during the Q&A session with Wall Street analysts.
It is jarring. We have just spent the last 45 minutes detailing a quarter that beat revenue expectations, posted $95.5 billion, swung to a positive $2.1 million EBITDA, launched a blockbuster dental platform, and grew aerospace by 20%. The narrative is triumphant. And then CFO Phyllis Nordstrom reads the forward-looking guidance for the second quarter.
And the air just goes out of the balloon.
I'm looking at the literal transcript. They guided Q2 revenue at a range of $93 million to $95 million. That is sequentially lower than Q1. And even more shockingly, they project a return to an adjusted EBITDA loss of $2 million to $4 million.
They are telling investors that the cash-generating engine they just celebrated is going to start burning cash again for the next 90 days.
If I am a retail investor reading that press release, my immediate reaction is panic. Did the turnaround just run out of gas after exactly 3 months? Did the dental surge evaporate? Did aerospace cancel their orders? How do you post a massive victory and immediately guide for a sequential decline and an operational loss?
To prevent a panic sell-off, you have to deeply understand two completely separate dynamics driving that guidance: the behavioral economics of medical seasonality and the extreme prudence of a CEO navigating a broken supply chain.
Let's unpack the seasonality first, because when I hear seasonal business, I think of a company that sells snowboards or a retailer dependent on Christmas shopping. I do not associate seasonality with industrial lasers and titanium implants.
Under the old industrial model, you wouldn't. But remember the historic data point we established at the beginning of the deep dive.
The segment flip. Healthcare is now officially the largest portion of their revenue.
Exactly. And because healthcare is now the dominant financial engine of 3D Systems, the company is suddenly heavily exposed to the behavioral psychology of the average human patient. Jeff Graves explained this dynamic brilliantly on the call. He referred to it as the vacation effect.
The vacation effect. Walk me through the psychology of that.
Think about the nature of the procedures 3D Systems supports. We are talking about highly invasive, albeit elective, orthopedic surgeries like knee replacements or multi-month, highly uncomfortable dental alignments and full-arch denture fittings. When do human beings voluntarily schedule major, painful medical disruptions to their lives?
Usually in the fall or deep in the winter.
Exactly, because in the spring and the summer, families go on vacation, the weather is beautiful, children are out of school, and people want to be traveling, swimming, and playing golf. A patient suffering from a degrading knee joint will actively choose to swallow painkillers and limp through a family trip to Disney World rather than spend June and July immobilized in a physical therapy ward recovering from a titanium implant.
That is profoundly logically human. They delay the pain.
They delay the procedure until October, when the kids are back in school and the weather turns cold. Because 3D Systems relies on selling the consumable resins for dental guides and the metal powders for those joint implants, they see a highly predictable, distinct drop in consumable volume during the spring and early summer. The hospitals simply aren't printing as many implants because patients aren't booking the surgeries.
So the Q2 revenue dip isn't a signal that the technology is failing or that a competitor is stealing market share. It simply means that the end user, the human patient, is currently sitting on a beach instead of sitting on an operating table.
Precisely. The inherent seasonality of the healthcare market is artificially depressing the Q2 revenue projection.
Okay, the seasonality explains the revenue dip. But what about the return to an EBITDA loss? And what about the CEO's overall tone? During the Q&A, a highly respected analyst named Greg Palm pressed Jeff Graves aggressively on this exact dissonance.
Palm was voicing the frustration of the entire financial sector. He essentially asked Graves, "Your narrative sounds incredibly optimistic. You are talking about massive technological wins and structural efficiency. Why is the actual numeric guidance so incredibly soft?"
And Graves gave an answer that was a masterclass in expectation management. He didn't offer excuses. He offered a dose of brutal geopolitical reality.
He did. His exact quote from the transcript was, "We are trying to knock it out over our skis in terms of excitement."
He explicitly pointed right back to the global logistics nightmare we just discussed. When your shipping lanes are choked by conflict and air freight capacity is constrained, a responsible CEO does not promise Wall Street a flawless quarter.
If 3D Systems projects a massive Q2 profit, and then one major European shipping port experiences a week-long labor strike, or a cargo ship gets delayed in the Red Sea, millions of dollars of hardware revenue gets trapped on the water. They miss their projected earnings, Wall Street punishes them, and the stock crashes 15% in a day. Graves is actively choosing to keep the guidance conservative. He noted that the macro world is slowly improving, but stated, "Let's not get out in front of ourselves and let's keep the guidance realistic."
It is the oldest playbook in corporate governance. Underpromise and overdeliver. But it is an absolute necessity when the physical delivery of your product requires navigating active conflict zones.
But there is one final, incredibly optimistic piece to the guidance puzzle that offsets the Q2 caution, and CFO Phyllis Nordstrom spent significant time detailing it. It concerns their research and development spending horizon.
Right. If you look at the financials over the last 3 years, 3D Systems has been burning a massive amount of cash on R&D. They were spending like a startup despite the macroeconomic trough.
It was an existential gamble by management. Graves knew that if they cut R&D spending to save money during the trough, they would emerge into a recovered economy with obsolete technology. So they maintained massive R&D budgets right through the worst of the economic freeze, absorbing the financial pain, specifically to completely reinvent their portfolio. That money funded the creation of the NextDent 300, the upgrades to the DMP titanium platforms, and the specialized oncology software.
And Nordstrom's message to Wall Street was, the heavy lifting is done. The massive multi-year innovation cycle is substantially complete. The portfolio is fully refreshed.
Because that massive R&D spend cycle is over, their operating expenses are going to definitively stabilize. They have locked in that $55 million in annualized savings, and they don't have a massive new hardware development program draining the coffers over the next 12 months.
Which explains the ultimate punchline of their guidance. Despite guiding for a sequential dip and a minor loss in Q2, management was supremely confident in stating that they expect their full-year adjusted EBITDA to be fundamentally break-even or entirely positive.
They are telling investors to look past the summer. They know the mathematical realities of the back half of the year. In Q3 and Q4, the patients come home from summer vacation and schedule their delayed surgeries, causing consumable revenue to spike. Simultaneously, the new 80,000 square foot aerospace factory in Littleton comes fully online, drastically increasing their industrial output. The back half of the year is structurally designed to compensate for the summer lull.
We have covered an immense amount of ground. We have analyzed the macroeconomic trough, dissected the $55 million in cost-cutting bloat, and explored the biological miracles of 3D-printed monolithic dentures and bespoke titanium oncology implants. We have debated the thermodynamics of binder-free laser sintering for aerospace turbine blades, and we have navigated the frustrating reality of global shipping bottlenecks and healthcare seasonality.
The diagnostic X-ray is complete. The various overlapping systems of the business have been evaluated.
Which means it is time to deliver the final verdict. We promised an actionable, opinionated synthesis of all this data. For the retail investor listening to this, what does this massive accumulation of data actually mean if they are holding the stock or considering initiating a position?
To provide a genuinely objective verdict, we must forcefully synthesize the best arguments of both the bears and the bulls and see which thesis holds more structural weight.
I will take the role of the skeptic. Let's build the bear argument. If I'm looking to short 3D systems or if I'm advising someone to sell, what is my foundational thesis?
The bear argument ignores the technological marvels and focuses entirely on momentum, macroeconomic vulnerability, and execution risk. The bear looks at the Q2 guidance and sees a massive red flag. Wall Street algorithms abhor sequential declines. The bear will argue that the vacation effect is a convenient excuse and that returning to an EBITDA loss in Q2 will completely crush the short-term momentum of the stock.
The bear says a loss is a loss, regardless of what season it is.
Furthermore, the bear highlights their extreme vulnerability to global logistics. 3D Systems is a hardware company in a volatile world. If the situation in the Middle East expands or if fuel costs spike, shipping heavy metal printers across the Atlantic becomes prohibitively expensive. Their margins will evaporate instantly. Finally, the bear points to that anemic 1.6% growth in the broader industrial segment. Outside of the classified defense contracts, traditional factories still aren't buying. If a true, deep global recession materializes, that 1.6% growth will quickly turn negative, dragging the whole company down.
It is a highly credible, mathematically grounded bear case that respects the dangers of the physical supply chain. But every coin has a reverse. Let's build the bull argument.
The bull argument is entirely focused on structural transformation, operational leverage, and impenetrable regulatory moats. The bull looks at CEO Jeff Graves and sees a visionary leader who made a terrifying bet to maintain R&D spending during an industry depression and miraculously pulled it off.
They didn't just survive the winter by rationing their food, they spent the winter building vastly superior weapons.
Exactly. They emerge into a thawing capital environment possessing an unmatchable, fully refreshed portfolio of advanced polymers and pure metals. The bull points to the 600 basis point expansion in core gross margin as undeniable proof that the factory floor is operating with ruthless efficiency.
And the bull's ultimate weapon is the segment flip.
It is the bedrock of the bullish thesis. Healthcare is now the dominant revenue engine. Dental restorations and oncology implants are not consumer discretionary purchases. They are highly inelastic, deeply entrenched necessities protected by massive FDA regulatory moats. A competitor cannot easily replicate a 3D Systems titanium spinal implant workflow without spending years in clinical trials. The bull sees a structurally transformed company that has violently excised $55 million in administrative bloat, built a dedicated aerospace facility that is is already constrained by excess demand and proven it can generate positive operating cash flow in a tough macro environment.
So having weighed the vulnerability of the supply chain against the strength of the medical modes, what is our final opinionated verdict on 3D Systems based on this Q1 earnings call?
When you balance the temporary behavioral nature of the Q2 seasonal dip against the permanent structural improvements in their cost base and product portfolio, the verdict leans heavily bullish. But specifically for a patient long-term investor.
I align with that completely. If you are a high-frequency day trader looking for a quick pop next week, this stock will likely frustrate you. The Q2 seasonality and the unpredictable shipping logistics will create short-term volatility. But if you are an investor looking at a 2 to 3 year horizon, the Q1 data signals a profound structural turnaround.
The critical proof is that the margin expansion was an apples-to-apples improvement on the core business, not an accounting trick. The A&D momentum is organic, driven by the physics of binder-free sintering. The healthcare dominance is locked in by regulation, and their $86 million cash pile means they can weather the remaining geopolitical turbulence without diluting shareholders.
They have officially crossed the chasm from merely surviving an industry trough to executing a high-margin growth strategy.
The foundation has been completely rebuilt.
Which brings us to the close of our analysis today. We have traveled a massive distance. We started with a surprising $95.5 million top-line beat that caught analysts off guard. We dissected the historic inflection point where high-margin, heavily regulated healthcare revenue finally eclipsed traditional industrial prototyping. We explored how laboratories like Roe Dental are tripling output with jetted monolithic dentures, and we marveled at the bespoke PEEK polymer implants, changing the grim reality of bone cancer reconstructive surgery.
We examined the thermodynamics of direct metal printing, exploring how lasers and pure titanium powder are creating 25% lighter satellite brackets and flawless turbine blades, driving a 20% surge in aerospace demand that necessitated a massive new factory in Colorado.
We navigated the frustrating but deeply human reality of summer vacations, artificially suppressing Q2 medical revenue, and we weighed the vulnerability of global shipping lanes against the massive $55 million structural efficiency of their turnaround. We landed on a fundamentally bullish outlook for a company that has reinvented its technology while relentlessly tightening its belt.
It is an incredibly complex narrative, but analyzing every layer is the only way to find the truth behind the ticker symbol.
It is. But before we sign off, we want to leave you with one final provocative macro thought, something for you to deeply consider as you watch the global economy evolve. It builds on the tensions we've discussed today, but looks decades into the future.
Throughout this deep dive, we continually bumped up against the fragility of the global supply chain. Cargo ships delayed in the Red Sea, air freight constrained, the massive logistical headache of moving heavy things across oceans.
That friction defines modern global trade. But consider the core promise of the technology 3D Systems is perfecting. As additive manufacturing permanently transitions out of the realm of rapid prototyping and becomes the literal, certified mass manufacturing backbone for life-saving trauma implants and classified hypersonic rocket propulsion, are we witnessing the beginning of the end of the traditional globalized supply chain?
It is a profound question. If an aerospace engineer can securely transmit a digital file, and an 80,000 square foot facility in Colorado can instantly print a flawless titanium jet engine component using raw powder, you no longer need a massive cargo ship to transport that finished engine part halfway across the world from a foundry in Asia.
Exactly. If a hospital in London can scan a trauma patient and a printer in the basement of that exact hospital can instantly manufacture a bespoke surgical implant, the medical supply chain collapses from a 5,000-mile journey into a 50-foot walk down the hallway.
Are we moving away from a geopolitical world reliant on controlling massive maritime shipping lanes and vulnerable geographic choke points?
And instead, are we witnessing the birth of a vastly more complex, hyper-localized manufacturing arms race? A future where global economic power isn't dictated by who controls the cargo ships, but by who controls the highly guarded digital files, the proprietary biocompatible resins, and the pure metal powder required to print the future on demand entirely locally.
It would completely redefine the geometry of international trade and national security.
It absolutely would. And it proves that our original diagnostic metaphor holds true. When you look at the future of global manufacturing, or when you analyze the anatomy of a turnaround stock like 3D Systems, you cannot just demand a clean binary X-ray. You have to be willing to wade into the murky waters, understand the complex overlapping systems, and recognize the massive structural shifts forming just beneath the surface of the data.
Because the future is rarely a clean break. It is built layer by microscopic layer.
We want to thank you so much for investing your time and joining us on this exhaustive deep dive. We hope you found the exploration of the technology and the financials as fascinating as we did, and that you walk away equipped with a much sharper, highly actionable understanding of the mechanics actually driving the numbers. Until next time, keep looking beneath the surface and have a fantastic day.